this is a foregone conclusion. They're going to raise rates. The only issue is whether it's by 75 basis points or 1 full percent. That's pretty much what the market is baking in at this point. What's the case that the Fed does not need to be more aggressive than its third straight 75 basis point hike?
Well, Dom, there are a few cases, but I am concerned that the Fed isn't listening as closely as they used to be to things like inflation. So we started to see inflation at least begin to roll over. Now, look, one little point down doesn't necessarily make a trend, but it certainly does break the trend that was in that we were suffering through, where we've also seen wages go flat as well. Those are two important things that the Fed should be paying attention to. And the fact that the long end of the curve, while it's still going up, is not going up by as much. In fact, it's starting to price in sort of less of a rosy outlook and potentially a recession.
If that's the case, if there is a recession possibly at play, is there any reason why you wouldn't see some kind of a bid, some kind of a bit of buying bias towards longer-term treasuries? If there were to be an economic slowdown, why wouldn't you want to take a 3.5% yield on a 10-year Treasury note with money guaranteed by the full faith and credit of the U.S. government if you believe that we're at least heading towards a recession at some point in the next couple of years?
Well, Dom, if you believed that, then you would take that. Absolutely. I mean, if you look at the way that the yield curve is acting, it is quite frankly, I think, playing chicken with the Fed right now. And if you look at economists' forecasts right now are not yet forecasting a severe recession. If anything, they're forecasting just sub 1% returns for 2023. Now, that's not great. And equities don't perform well in an economy like that. But that's not a recession.
It's not a recession. So if that's the case, our markets right now, and we spent a couple of minutes here on the bond market, are equity markets now appropriately priced for what we think the rate outlook will be by the end of this year and where the rates will end up by the time the Fed is done with its tightening cycle?
Well, that is a good question, Dom. The Fed funds futures right now are pricing in the Fed to continue to go to about 4.5% at the Fed funds futures. I mean, for the Fed funds rate, which is the anchor of the curve. Now, if they did that, then no, the equity markets are not priced for that. The equity markets are barely priced for 3%. If we actually remain in the 3 to 4% range well into 2023 and on into 2024, the equity markets are not yet priced for that either.
All right. So if they are not yet priced for that, do you go back in the markets now and continue buying equities? Do you just wait, sit with cash on the sidelines? Or are there at least dislocations enough in the market where you can find opportunities? And what types of stocks and industries are you looking at then?
Well, to be honest, Don, I'd go up the capital structure. I mean, right now, if you don't believe we're going into a really severe recession that's going to cause a whole lot of defaults, then you should probably be heading into credit right now. There's probably going to be interesting distress situations. And this is an area that's been dead for 10 years. But there's probably going to be some interesting situations where you can get some really good yield on companies that are, quite frankly, solid, that just need some liquidity. And so there could be some opportunities higher up the capital structure. Within the equity markets, you have to be careful. You know, if anything, I would say that the growthier parts of the equity markets have probably priced in more than the value segments. There are parts of tech right now that actually look attractive, but you do have to be careful because quality is king, cash is king, and that's what you have to look for.